Welcome back to the Mortgage Reports. Today we're breaking down something that can seriously simplify your finances: debt consolidation through refinancing. Now, if you're feeling stretched thin with multiple bills like credit cards, car loans, or medical payments, you might have heard that you can roll all of that into your mortgage. But what does that actually mean? Is it a smart move or just trading one kind of debt for another? In this video, we'll go over what a debt consolidation refinance is, how it works, what to watch out for, and some real-life examples to help you decide if it's right for you. Question 1. What exactly is a debt consolidation refinance? A debt consolidation refinance is when you take out a brand new mortgage that's bigger than the one you currently have and use that extra money to pay off other debts. Here's a simple example. Let's say your home is worth $400,000 and you owe $250,000 on your mortgage. You decide to refinance for $300,000. That's an extra $50,000 that can go toward paying off your credit cards, a car loan, or personal debts. The big draw here is interest rates. Mortgage rates are usually much lower than credit card rates. So if you're paying 20% on your credit cards, but your new mortgage rate is 6%, consolidating could save you thousands in interest. You'll also replace multiple payments with just one, your new mortgage payment. But remember, when you move those debts into your mortgage, you're turning unsecured debt into secured debt, which means your home is now on the line if you can't make the payments. Question 2. How does this process actually work? Well, it starts a lot like a regular refinance. You'll apply with a lender, go through a home appraisal, and show your documentation for your income and credit. To qualify, you'll need to have some equity built up. Now, most lenders want you to keep at least 20% equity after refinancing. So once you're approved, your old mortgage is paid off and you get the difference in cash. That lump sum is what you use to pay down your other debts. After that, all your payments are rolled into your mortgage. So let's say your total payments for different debts add up to $2,000. For instance, your mortgage is $1,400 and another $600 in credit cards and personal loan payments. After consolidating, your new single mortgage payment might be around $1,600. That's $400 of monthly breathing room and a lot fewer bills to juggle. Question 3. Who typically qualifies for this kind of refinance? Well, lenders look at a few key factors: your credit score, your home equity, your income, and your debt to income ratio. Basically, how much of your income already goes toward debt payments. If you've got a credit score of around 620 or higher, a solid income, and some home equity, you're in a good spot to qualify for a conventional refinance. FHA loans can work for scores as low as 600, though you'll pay mortgage insurance. And veterans using a VA loan may be able to refinance up to 100% of their home's value. So here's a quick example. Imagine a homeowner named Sandra. She owes $180,000 on her home, which is now worth $300,000. She also has $20,000 in credit card debt. Because she has a solid income and a credit score of 700, her lender approves her for a new $220,000 loan. Sandra pays off her mortgage and wipes out her credit card debt in one move, leaving her with one low interest payment. Question 4. What are the main benefits? There are a few big ones. First, you'll likely pay less in interest. Credit card debt can easily hit 20% or more, while even today's mortgage rates are much lower. Over time, that difference adds up to serious savings. Second, it simplifies your finances. You go from tracking 5 or 6 bills with different due dates and rates to just one monthly payment. That can make budgeting much easier and reduce stress. You might also see a credit score bump. Paying off high credit card balance lowers your credit utilization ratio, which is a major factor in your score. And lastly, mortgage interest may be tax deductible, depending on how the funds are used and your personal tax situation, something to confirm with your tax advisor. Here's an example. Brian and Taylor have $30,000 in credit card debt and a mortgage at 6%. By doing a cash out refinance, they replace that debt with one new mortgage loan. Their interest costs drop by nearly $400 a month, and their credit scores improve because they're no longer maxed out on their cards. Question 5. What are the risks and downsides? There are definitely trade-offs. The big one, you're putting your home at risk. Once you roll unsecured debt into your mortgage, missing payments can lead to foreclosure. That's not a risk with credit cards or personal loans. You also need to think about long-term costs. If you refinance into a brand new 30-year loan, you're restarting the clock. Even if your rate is lower, you might pay more in total interest over time. And don't forget closing costs, typically 2% to 5% of your loan amount. For a $300,000 refinance, that could mean $6,000 to $15,000 up front. It's important to calculate your break-even point, how long it'll take to recoup that cost through lower payments. Finally, the biggest danger is falling back into debt. For example, Laura refinanced to pay off $25,000 in credit cards, but then kept using those same cards. And within 2 years, she had another $20,000 in balances, plus a larger mortgage than before. So the lesson? Debt consolidation only works if you change the habits that caused the debt in the first place. Question 6. What other options should people consider? Now, if you don't want to refinance your whole mortgage, there are alternatives. A home equity loan gives you a lump sum using your home's equity, but keeps your existing mortgage in place. That's ideal if you are already in a great rate and don't want to reset your loan. A HELOC, or home equity line of credit, is another option. It's like a revolving line of credit that you can use as needed. It's flexible, but the interest rate can change over time. If you don't have much home equity or don't want to use your house as collateral, you might try a personal loan or a balance transfer credit card with a 0% introductory rate. For example, Marcus used a balance transfer card with 0% intro APR for 18 months to pay off $10,000 in debt, saving hundreds in interest without touching his mortgage. Each option has pros and cons, so it's worth comparing them with your lender or financial advisor. Question 7. So, is a debt consolidation refinance a good idea? It depends. If you have strong equity, stable income, and the discipline to avoid building new debt, a debt consolidation refinance can be a huge financial reset. You'll save on interest, simplify your finances, and potentially improve your credit. But if your mortgage is already nearly paid off, or you're unsure about your spending habits, it could backfire, leaving you with more debt over a longer period of time. Think of it like this. Refinancing is a tool, not a cure. Used wisely, it can free up cash and help you breathe easier. Used carelessly, it can dig a deeper hole. Before making a move, talk to a trusted mortgage advisor or financial planner. They can help you crunch the numbers and see if it truly makes sense for your goals. That's your full guide to debt consolidation refinancing, what it is, how it works, and when it makes sense. If this helps you understand the pros and cons, give it a thumbs up, subscribe for more mortgage explainers, and drop a comment with what topic you'd like to learn about next. Make sure to check out the full article on the mortgage reports linked in the description. Thanks for watching, and we'll see you next time.